The way the SPAC works, you build a company for as long as it takes you to build a company. You get it to a position where you think it can maybe endure the public markets. And then in that critical moment, you give somebody else who doesn't know your company at all a free option on effectively selling that company to the public for 3 months. That is completely insane.
Joey, I'm excited for this. I've heard so many great things from so many of your friends. So first, thank you so much for joining me today.
That's my pleasure. And if you didn't hear great things from my friends, I don't know who you'd hear great things from.
Well, I mean, they all said the same thing, which we're going to dive into today. But I want to start with a little bit of an abnormal start. But Joey, you have a fascinating position today. But what did you want to be when you were younger? When you said, hey, what do you want to be when you grow up?
I actually wanted to be a lawyer because my dad's a lawyer. I wanted to be Clarence Darrow. That was I had read books about him and stories about him, and he was from the Midwest, and he's a iconoclast in a lot of ways, and that was what I wanted to be.
Did you fit in school?
Yeah, but more or less fit in. I think so, yeah. I mean, I wasn't a great athlete, but I had other things that I focused on.
You turned into a great golfer. That's what counts. I'm intrigued. Some people feel this kind of success was always like inevitable. They may not have known where it came from. Did you feel that you'd always be successful?
No, but I do think that one of the things that's important I see in a lot of successful people is they come in clusters. I think that the reason they come in clusters is because they have good role models, or they see what's possible. In other words, if you're in a group where, and there's a sort of natural competitiveness too, but if you're in a group where people are achieving certain things, you realize that that level of achievement is possible. I think I've been a beneficiary of that in a lot of the environments that I've been in.
Who's your closest mentor? You said about coming in clusters there and learning from people. Do you have a mentor or two that really stand out?
I have been very, very fortunate to learn closely from some amazing business people. Of course, Barry Diller, who I still work with every day. Jack Welch was a very close friend and advisor. I have my family. My dad has been a big help to me and advisor me in business, and my brothers too, and my whole family.
So I think one thing that I loved about your background was also like duration. You've been at IAC now for 20 years, since 2003, I think it is. And so when we look back, it's rare to have such duration, especially today. If you look at 1 to 2 elements where your career really propelled within IAC internally, what were they, do you think?
It's a series of things that build on top of each other, but if I was probably going to narrow it to 2 traits, maybe, one is, I think, hard work. I have generally and continue to try to work hard. I try to know more and learn more, and that doesn't mean hoarding information. It's very important in an organization that everybody shares information and uses that information as currency valued internally against people externally. But doing the work to have the information, understand things better, I think is really important. And I generally did that going back to, individual deals where I'd try and learn everything. When I was doing mergers and acquisitions, it was to learn everything about a company that we were considering acquiring, reading all of their public filings, reading all their transcripts, reading everything that they've published to really understand it inside and out. And I think that was important in terms of hard work. And then having opinions. My opinions were definitely not always right, but having opinions, I think, is a really important thing to advancing in an organization, because you stand out with opinions. You take a position, and taking a position is an important thing to do.
Do you agree with strong opinions loosely held?
Yes, very much so.
Good. I'm glad. I'm very much one too.
Very much so.
We mentioned duration there and the length of time you've been at IAC. As I said, we don't see that very often today. When you advise grads, your children even, about coming out of school into the workforce, what do you advise them given the experience that you've had?
A little bit like we were talking about before we got started here, but if you're doing something that you really love, that excites you, then you can do it for much longer. It doesn't mean you don't have to do anything uncomfortable. It doesn't mean you don't have to do anything that's challenging, but if you're doing something you love and that excites you, it just feels different. You're willing to do it. And if you find that, and it's very sometimes hard for people to find, and you're lucky to find it, but do that. And you sort of, to help people find it, you ask them, well, what are the kind of books you read? What are the kind of websites you read or magazines or whatever it is. What do you listen? What are the podcasts you listen to? And you pick up a theme. Maybe it's sports, maybe it's business, maybe it's art, maybe it's marine biology, whatever it is. If there's something that really fascinates you, even if you haven't identified it, your actions are identifying it. And so like the books that I read growing up were not a lot of other people my age read these books, but they were business books, and I loved reading the business books, and that was the kind of thing that fascinated me, and that's what led me into this kind of career and made it so I could stay a while and do it a long time because I love what I do.
Can I ask, you mentioned there about doing what you love. It's not always easy. I think people often look at the shows with me and they're like, oh, it just worked, and it didn't. When you look back at IAC, what was the most challenging period?
I'd say we're going through a challenging period right now, in a sense. It's always, and we've been through a similar period in the past. It is when there is a big negative adjustment in the surrounding environment. Everything changes very quickly. Valuations change really quickly, which is probably what's most acutely felt, but everything changes very quickly. Your ability to generate revenue changes very quickly. Your ability to manage your expenses changes very quickly. And your ability to get credit for things changes very quickly. And when those things happen, it's a big adjustment. It's a big adjustment because, one, just dealing with those things individually is hard, but two, the organization isn't used to it. Meaning, if for people who joined the organization in the prior 10 years, let's say, it was nothing but up. Now, no organization goes up steadily forever, but they were in an environment where for 10 years they saw nothing but up. And so you can develop habits and develop points of view that are related to that and that are unhealthy and that need to be unlearned and that need to be changed. And so managing that kind of change among people in an organization is a hard thing to pull off.
I got asked this one. What behavior traits or attitudes do you think have been most dangerous that this generation have lived through only in the best of times have picked up? What are the most dangerous traits?
I think the most dangerous one, and this is the same thing we do with our kids, and I'm certainly guilty of it. The two biggest sort of macro finance events of the last decade or so, or more than a decade, I should say, was 2008, the great financial crisis, and the pandemic. Those were two very profound ones, right?
Uh-huh.
In both of those cases, there was a government bailout. And I think the government did the right thing and saved jobs and saved the economy and did really important things in that. But the lesson that's learned is there's a bailout. So whatever you do, there's a bailout. And that's, not always available and not always true. I'm all for long-term optimism, but I think that the level of entitlement that we see in the younger generation of that year or those years is I think related to that, a general bull market supported by when things go wrong, don't worry, somebody else comes to the rescue externally.
But do you think that realization has set in? Sorry, I'm just going for this one. I hire for my teams constantly, and people still want exceedingly high salaries. They still want exceedingly high bonuses. They still want work from home. They want work-life balance. They want equity. I want. Well, what about what the business needs?
Look, we're at a period where a lot of things are cyclical, and I think that will come back into balance over the next few years.
How do you manage that morale internally? Because it is nerve-wracking for a lot of younger people who've never seen this before. You're a silver fox in the room with wisdom. How do you manage their morale and talk to them when they are shitting themselves about what could be their first working recession?
Well, we have we're lucky to have something at IAC, which is a lot of people with tenure. So they both are very familiar with IAC and the way we operate, and they've been through a lot of different cycles and markets and environments. And so you have a mix of people like that and people who have not had that experience. And I think having that mix in an organization is really helpful for striking balance and learning, because if it's all the people who haven't experienced those things and then sort of one person who has the knowledge or did the research or has the experience, then it could be, well, that person's out on an island and they don't get us and they don't get what's going on. But if you have a mix of those things, then I think you're you've got a breadth of point of views where people can interact and have a dialogue around that.
You mentioned like changes in a lot of different things, but you mentioned changes in valuation. I'm intrigued because you said before to me that there's no such thing as value investing. As a reader of Benjamin Graham's book, I was naturally intrigued. So why is there no such thing as value investing?
Well, what I mean by that is people use the word value investing to mean buying things at low multiples or buying things cheap or deep value or whatever. And that is a way to invest, but value investing also can be buying something at a very expensive multiple or I shouldn't say expensive, I should say a very high multiple, but that there's value there because of what you believe in the growth and the future. I'm maybe sensitive to this because people say IAC is a value investor, and that doesn't bother me as a term, but so is, I don't know, pick a name of a VC or a growth equity fund that pays very high prices for growth things. Like, they think they're a value investor. They are a value investor. They see value there relative to what they believe the future value is, and I'd call them a value investor too. And for us, we do both. So we are a value investor, but we're not saying we have to buy everything really cheap. We have to buy as an absolute multiple. We could pay big multiples for things where we see big value, and that can work out too.
It's funny, I remember when Sequoia invested in Figma, it was rumored to be a $400 million valuation, which was 100 times revenue, which was crazy. At the time, it was $4 million, and everyone thought it was ridiculously high. I think they would argue that that was a value investment or a good value investment.
Correct, totally. And there's so many examples of that. I mean, there's obviously examples of the opposite, but I would call that value investing. I would say they're a value investor.
Do you know what I find hard, though, is there's this trait, or saying, be greedy when others are fearful and fearful when others are greedy. The trouble is, if you want to be greedy when others are fearful, you need other people, if you're reliant on cash, to share that greed. And what I'm seeing now is there's a lot of opportunities, but people aren't willing to fund them because they share everyone else's fear. How do you think about having the courage to be greedy when others are fearful?
Well, you've hit on a very important point, which is you need capital to be greedy when others are fearful. And that means that you need to have been preparing for that moment in advance. Now, no one can time those things right, but you need to have been operating in a way where you have the ability and the capital to be greedy in those moments. And that's a very hard thing to do. But you're right. Everybody right now is talking about, there's so many opportunities, there's so many things that I want to buy. I just don't have enough capital to do it. Well, of course, that's what's happening. When capital is scarce, things are cheap, and when capital is abundant, things are expensive. Where the opportunity is when you've built up capital and been able to hold on to it through those periods to be able to take advantage of the moments to be greedy.
Do you feel you and IAC built up enough cash to be greedy when others are fearful?
I think we certainly have plenty of cash right now we're well over $1 billion of cash and no debt at the parent level. And so we are well capitalized to take advantage. Do I wish we had more? Of course, I wish we had more. I wish we had a lot more right now, but I'm happy that we have what we have, and I think we'll make opportunities with that.
In the assets you're looking at now, are you seeing valuations reflect the macro? Because I think the biggest challenge for me is I'm a seed investor predominantly. Seed investing is completely the same, if not slightly higher prices than ever before. The prices aren't reflective.
The private markets and the public markets can be very far apart in moments of are generally very far apart in moments of transition. So I think public markets are reflective of the environment right now, and private are not. And there's a bunch of reasons for the private not being. One, people raised a lot of capital when capital was easy, and so having that capital chasing those deals, that still exists. Number two, you don't need to be honest on valuation every day. There's no one forcing that. So if you have enough capital in a business, you would not go and get a valuation right now. Number three, everyone in the ecosystem is incentivized and able to maintain sort of pretend valuations, meaning the investors want to keep their marks where they are. Their LPs actually want them to keep their marks where they are because they don't want to look bad. The companies want to keep the marks where they are because they want to retain the employees. And there's nobody in that ecosystem whose job or responsibility is, let's make this more accurate and more realistic. And that only happens when you have to go access the capital markets and then get somebody new into that story. You also have nobody in the ecosystem. Like public companies also have short sellers. So the people who don't believe get to vote in addition to the people who do believe. But in the private markets, only the people who do believe get to vote. So that's going to be a skewed vote.
I had Orlando Bravo on from Toma Bravo yesterday, actually, and he argued that, bluntly, this is the new normal, and actually it's relatively reasonable. We saw the result of quantitative easing and, increased capital supplies, as you said, from government intervention. And this is actually not bad. It's reasonable and it's the new normal. Do you agree with that statement that this feels reasonable in the new normal?
I do agree with that. Yeah. I think that this is, we are where we are right now. And now we need to grow from here. There's no snapback. Even if you say earnings take time to grow, earnings don't typically at large grow in multiples. They grow in, increments, percentages. And when that happens, markets grow and valuations grow, but there's no catalyst that I don't think anyone can define, which is multiples are going to expand soon. You need interest rates to come down. You need tax rates to come down. And then things like that, like multiples can expand. But I think we are naturally where we are, and I think it's fine and appropriate.
We've spoken a lot about kind of value. In terms of like digging a layer deeper to kind of actual value creation, I've heard you say before, simplification is the most powerful tool in value creation. What did you mean by this statement, Joey?
Simplifying is our margin in all of our business. That's what entitles you to margin. If you take your customers, a lot of our businesses have customers on two sides. We have marketplace businesses where there's a supply and demand side, and both of them are our customers in a sense. Your job in the middle, even if it's not a marketplace business, is simplification. You are simplifying something on behalf of your customers, and they are paying you a margin in order to do that. The more you simplify, the more margin you're entitled to, because that's how you create value for your customers. But simplification also goes into well beyond to simplifying the product for your customers. It's like simpler pricing is easier for people to sell. Simpler decks are easy. Presentations are easier for people around you to understand and appreciate. Everything, when you simplify, when we have any process online where we're trying to sell something, anytime you take a step out of that process, you increase conversion. You're simplifying. And if you use that as a tool, there is not a moment in business where you can't think about that as a improvement opportunity and yield value from it.
What do you think are the biggest mistakes that people make that you see around you in failing to simplify?
Taking on too many projects at once. That's a huge one. People say, all people cared about, if we go back to the prior market, all people cared about was TAM, total addressable market. And they said, my TAM is so big that I can do so much in this TAM, and I have to get all of this TAM, and I have to launch all of these products to tackle the TAM. That mistake was spreading yourself too thin, taking on too many competitors or markets at once. And we saw a lot of people do that when they had too much capital to overextend themselves and complexify rather than simplify.
I think one of the biggest failings I see in simplification is messaging. How often do you see, especially a B2B, but how often do you see a website and you're like, I'm not quite sure what they do?
I get that all the time. I mean, I get emails from people who say, would you consider investing in my business? And then they say a series of 8 words that I could not translate into any English.
Yeah. I think that, so what does great messaging mean to you? You have a series of phenomenal businesses within, IAC that I think nail messaging very well. What's been your lessons on what makes great messaging?
My dad, when my siblings and I were growing up, forced us to read a book and then memorize a line or a portion of the book, which was William Strunk Jr. and E.B. White, The Elements of Style. Now I might mess it up a little bit, but a sentence should have no unnecessary words, and a paragraph no unnecessary sentences, just as a drawing should have no unnecessary lines and a machine no unnecessary parts.
I love that. When I think about that's brilliant. I'm going to use that. The joy of this show is that I can just take other people's wisdom and pass it off as my own in future. But a fantastic joy of life. Welcome to venture capital. The problem with simplification is you have to understand the distinction between an opportunity that you should take and actually a distraction, an unnecessary part, as you put it there. How do you think about that distinction between a very exciting opportunity or a distraction away from the core?
Yeah, this is something that I was used to be very skeptical of, and now I've embraced, which is a company should have values. We just rolled this out at Angie. I've been CEO of Angie in addition to IAC for the past few months, and Angie did have values before, but I'm not sure they were lived every day in making decisions. If you have values that are unique to your company that you believe in, it actually really does help in understanding the difference between an opportunity and a distraction.
Can I just ask? Sorry, I'm too intrigued. I have so many people say like, "Oh, it's about values," and I'm like, well, everyone's values are kind of the same, aren't they? It's like trust, honesty, truth, hard work, integrity. Like, what's different?
Yeah, so I pushed hard when we redid them at Angie to make them unique. So for example, the first one now at Angie is build lifelong customers. That changes a lot of decisions that you make in an organization. If you're trying to get a customer for one transaction, you can make a whole series of decisions to do that. And if you're trying to get a customer for life, you make different decisions in each of those situations. And what you really want, and this is I've said to the organization, and I say repeatedly, the values should make you uncomfortable. Not always. I mean, but there should be times where they force uncomfortable decisions and uncomfortable discussions where you have to call out colleagues, not in a mean way, but where you have to call out colleagues and say, wait a minute, has this been through the values filter or not? Because to me, it seems like it hasn't been. And you're right, things like integrity, like that's an obvious one. But things that build lifelong customers, there's different ways you'd prioritize a product roadmap. There are different features you'd release. There are different ways you'd communicate and present if you're trying to do that. First, again, in the example of Angie, it was previously customer first. Okay, customer first, I get it. But then what's second and third and fourth? And when do you come back? Like, build lifelong customers is a very challenging thing to do, and it has absolutely changed our roadmap and our priorities, and will going forward.
You mentioned being CEO of Angi and IAC. If there's one thing my investors are worried with me about, it's that I do too many things between media companies and funds. I naturally tell them that it's not a problem at all. CEO of two companies.
Well, you're right about that, I think, when you tell them that, because you're doing things that you love that that feed each other. If you were doing something that you didn't love, that you just had to get done, or some obligation, whatever, I'd say they're right. But what you're doing is things that naturally feed upon each other and are that you're doing these things in your free time because it is your free time. You know, it's the otherwise you'd be, playing golf or something. I don't know.
So my question, I really appreciate that, and I feel guilty turning this on you then. But are your two CEOships inbuilt as mine are, and how does that work then for you with the interplay?
I have the time to do it. I have colleagues at IAC who are highly capable of helping out in other areas, and they've stepped up to help. In particular, our CFO, Chris Halpin, Barry Diller, the chairman, has stepped up in other areas to help so that I have made time here. And, there's work-life balance is a challenge, and so it's definitely taken from away from personal life. But as I said, I love doing it. I enjoy both the Angie business and the Angie job and the IAC business and the IAC job. And I'm lucky that I get to do both, and I figure out how to make time for both, and I do.
I totally agree. I think work-life balance is a little bit of a myth, to be quite honest.
I agree. You have to nothing is so extreme, it's one or the other, but there are people just fundamentally that make a choice, and some choose work and some choose life, and I don't begrudge anybody which one of those two things they choose, but that's a choice. That's a fundamental, I think, dividing line.
We mentioned kind of opportunities that one should or could take. An opportunity that many took over the last couple of years was to SPAC, obviously an alternative mechanism of going public. And when you look at SPACs today, I think 98% are trading abysmally below trading price originally. Why did they not work as a mechanism, Joey?
There's a bunch of concepts in the SPAC that are flawed, but the most underrated in my mind, but also the biggest flaw was the way the SPAC works. And we looked at this with one of our companies that we're involved in. The way it works is you build a company for as long as it takes you to build a company. You get it to a position where you think it can maybe endure the public markets. And then in that critical moment, you give somebody else who doesn't know your company at all a free option on effectively selling that company to the public for 3 months. That is completely insane. That does not make sense, I don't think, for any great company. It can make sense for other things, but I don't think it makes sense for any great company. It can make sense for an idea where you need somebody to help go fund an idea for you. So these things, actually, a lot of the things that went out early that are sort of ideas or a little bit more than an advanced idea, but have no business yet, haven't built a business around it. That's just saying we need help fundraising, go figure out how to fundraise this for us so that we can continue building this idea into something that may be a business. But if you have a business, you'd be crazy to give somebody a 3-month or multi-month option on selling your story to a new set of investors.
But I would argue if you don't have a business and you have an idea, we saw many kind of early ideas, very, very early products with no revenues for sure. SPAC, you're placing all the pressures, demands, and expectations of being a public company on a very early product team org structure that's not ready, that distracts it from building product, that distracts it from messaging, from you name it. It's a completely suboptimal structure, no?
It only depends relative to your alternatives. If you ignore the thing that they got out of that, which is very important, which was capital. Now, if you say they could have gotten capital somewhere else, then I'd say you're right. But in many of those cases, actually, they couldn't get as much capital or nearly as much capital as they got in the public markets, and now they need to endure all those difficult things, which are a real challenge, but they got something really important, which is the capital to fund the business.
What do you think are the biggest misunderstandings or misnomers that people have or carry towards SPACs?
I still think the biggest one is nobody understands this, or not nobody. Few appreciated the reality that you're giving away an option on your company for an extended period of time, and it became so clear, it becomes crystal clear in volatile markets. And it's also like, like options are, it's sort of a one-way option, which is if things are going up, you gave away the option too cheap. If things are going down, you get it back. And so it's in every case worse for you. But there was a good that came out of SPACs, which is a lot of these companies that did SPAC now have to confront the public markets, now confront more sort of realistic valuations. And I think that's an opportunity for people with capital to find real opportunities.
So what happens to when we look at the generation of SPAC companies? What happens to them? Do they get taken private at much more realistic valuations? Do they?
Maybe, or they grow out of it. But I mean, one of the problems, which I didn't appreciate until somebody who knows this well said it to me, was Henry Ellenbogen who said it to me. And he predicted this 3 years ago or whatever it was, very early in the SPAC thing. He said the problem is going to be there's only a handful of investors who invest in public investors who invest in companies of this size. And to be a thoughtful investor, obviously it takes time to do work and analyze a company. The volume of companies coming into this size, it way exceeds the capacity of people to analyze and invest in those companies in the public markets. So what happened is they just have no home. Which means they'll either have to grow out of that by being big enough that people have to pay attention to it, or they'll probably go back private and try and work things out there.
Can I ask you, we see a lot of changes in markets. One thing I would like to discuss is also changes just in you as well. And over time, we have changes to our financial profiles. And one that's always an interesting one is kind of one's relationship to money, I find. How do you think about your own relationship to money today, Joey?
It's certainly evolved over time, but somebody I knew well once said to me, money is around. Sometimes it rolls towards you. Sometimes it rolls away from you. And you got to remember that that's true. I mean, never did I have a more distorted sense of my net worth than probably in November of 2021. And, you look at things on paper and then things change. And I always sort of had a sense or the knowledge that was possible, if not likely, that, things go up and down. But when it happens so severely and so quickly, you appreciate how real that truism is. And I do, but also, you got to put things in perspective. I remember the first time I made money, I was running a business for IAC, and I had a deal where I got paid a certain amount if we hit a certain amount of metrics or a certain level of metrics. And when we did that, I and my colleagues got paid very well, and that was very exciting. And I felt like the richest person on earth. And I did a fun weekend with my friends, and I said, this is like top of the world. And then, you go on to do more things and you earn some more. But then you have this crash and you say, oh, I feel like I've been crushed and whatever. But if I look back, I say, well, I'm doing much better now than I was when I felt like I was the richest person on earth. And if you put those things in perspective, I think you can get a little more relaxed about these things. Money is, another friend of mine said to me, above a certain level, money is just a scorecard. And I don't think and he wasn't saying that it should be a scorecard. He's just saying that's what it is. And it's not that important in that context.
I think one thing that's also very challenging is when you have children, and they're brought up with bluntly nice financial surroundings, but wanting to instill the same level of hunger and ambition and drive in them. How do you think about instilling that same kind of moral compass and like discipline, drive, hunger in children when money is less of a daily thought and concern?
Yeah, I think that's a very hard thing to do as parents, and I'm not sure we figured it out. I will tell you that my wife is much better at that than I am, and she does a very exceptional job keeping our family and our children grounded in things. We're very lucky in that sense to have that and have her relentlessness in that area. It's still a hard thing to do. When you think about what builds strength of character, whatever it is, adversity. Another thing another friend said to me is, we know that adversity builds these things and these important features, and all we do as parents spend all our life making sure our children avoid adversity at every possible turn. And that's a conflict that I haven't really reconciled and probably need to do a better job reconciling.
You mentioned, bluntly looking at net worth in 2021 and on paper feeling very, very rich. My biggest mistake over the last few years was bluntly not selling positions when I could have done, and bluntly made a lot of money where I didn't because I didn't sell them. When you look back over the last few years, what do you think back on as your biggest mistakes in doing or not doing in the height of the good times?
Look, again, would it be nice to have more capital right now? Yes, to take advantage of more opportunities, for sure. It's easy to look back and regret not having sold something, but people do this to themselves, and it's very unhealthy, and I don't recommend it. Everyone says, oh, I had the opportunity to buy that. I certainly would have bought it at the bottom when I was thinking about buying it. And I had the opportunity to sell that. I certainly would have, if I had known X, Y, and Z, I would have sold it at the top if I had sold it. It's very, very, very rare that you pick the absolute bottom and the absolute top for any of those decisions. The reality is you would do somewhere near one of those things and somewhere near another one of those things if it works out exceptionally well, but you're never going to get those things perfect. And the important part, the way to govern it is, as it relates to investments, is it a business that you believe in? Is it a team that you believe in? Is it a market that you believe in? And if it is, then over time, those things will balance out. And you want to hold on to the long-term winners, and over time, they'll continue to win.
You mentioned earlier that we said about the role of money there. You mentioned earlier family, and your brothers and your father. Can I ask, how has your family impacted your mindset, impacted how you think as a leader today? And have there been some prominent takeaways or lessons from them? I loved what your father made you read out, but have there been some big takeaways?
Well, yeah, I mentioned them. I didn't mention my mom yet, but another huge influence on me, my mom was and remains incredibly frugal and did a wonderful job forcing that upon me and my siblings in ways that did drive us. I mean, when we would go out to dinner, we would go to the food court at the mall and we would get one drink at the place that had free refills and then pour it around and then go get a refill and pour it around to each other. And like wherever there was a deal to be had, we had to get the absolute best deal. You could not possibly pay full price for anything. when we went to a restaurant, you could never get soft drinks at a restaurant because the margins were too high on soft drinks. You could never get the add-ons because the add-ons would add up too quickly. And there was a section of the menu where the prices were too high, where you couldn't look at that section. You could only look at the other section. Like, those were, and this is, I'm not suggesting we had any hardships in that sense, but that was building these values, which is, what do I have to do to be able to look at that other section of the menu? Or what do I have to do to be able to order a soft drink or whatever? And those were the values that we had growing up, and that had a real impression on us.
Can I be really divisive? Do you agree with that? Like, isn't that a bit harsh on kids? Like,
no, look, I do agree with it. I haven't had the fortitude, or whatever you want to call it, to do it myself with my kids. But I do think that is good. We would go out to dinner with other families. All the other kids would order a soft drink, and we would have no soft drink. And we loved soft drinks like everybody would. But we didn't. And so that created some ambition and drive, and I think that was healthy, actually.
You said about ambition and drive. Final one before a quick fire. The biggest commonality that everyone told me about you, Joey, was your unwavering persistence, your inability to give up, whether it's a bunker shot or business. My question to you is, there is sometimes a time to give up. How do you think about when to give up versus when to continue and push through the hard times?
Yeah, it's a very important question in a lot of the things that we do. You got to go back to, what is your thesis, and do you have a viable thesis that you believe in? It can't be because you believed in it previously. It has to be, do you believe in it today? We've told this story a lot with a business that we have called Dotdash, is now merged with Meredith. It's called Dotdash Meredith. But that evolved from what was originally an acquisition called About.com. When we bought About.com, we had a thesis. It was going to be part of Ask.com, actually, and we had a view on what we could do with it. And Neil Vogel, who was running that business, had a plan, whatever, went out with the plan, bombed. Came back in, he said, well, that plan bombed, and he said, but I've got a new plan, and here's why I think it's going to work. And everything he said made sense to us, and we said, okay, go do that. Bombed. Comes back in, he says, that one bombed, but I got a plan. Now this one's going to make a lot of sense, and here's why it's going to work. And everything he said made sense, and we said, okay, go do that. I can't remember if it was the third or fourth try. I think in one of them I said, we're not going to, I think after the third try I said, we're not going to have a fourth try on this. But whatever it was, the third one worked, or whatever it was, worked. And each one of those decisions independently was the right decision. But you could also be at a point in these businesses where you say that thing bombed, and then they come in with a plan that doesn't make sense, that doesn't resonate, and is just, let's keep doing the same thing that we were doing that wasn't working, and then it's time to get out. Or find somebody else who could come up with a plan that makes sense. But you can't let it be burdened by the sunk cost of the history. You can't let it be burdened by what your thesis was previously. You got to evaluate it fresh on the merits, and if it works on the merits, then you can swing for it again.
Are the best CEOs the best resource allocators?
Yes. It's balancing short-term and long-term. That's the hard part of the job. Anyone can do all short-term or all long-term, but balancing short and long-term, balancing capital and resources against short and long-term is the hardest and most important part of the job.
I would love to move into a quick fire round, Joey. So I say a short statement, you give me your immediate thoughts. Does that sound okay?
Sure, let's do it.
So work-life balance, we live in an entitled generation. Do you agree?
I do.
Good. What have you changed your mind on in the last 12 months?
I was expecting, and in some ways looking forward to, the market reversal that we've seen. And now in it was much more pleasant before that.
What's the shittest part of it?
It's just the adjustment that everybody needs to endure, in particular around jobs.
Biggest strength, biggest weakness. What's yours?
I guess I probably agree with the folks who told you what they told you, which is I have trouble giving things out.
Is that a strength or a weakness?
Sometimes it's a strength, sometimes it's a weakness for sure.
You can have one board member, okay? Just one. Who's the board member and why?
Well, I would go back to, he's no longer alive, but the Jack Welch had the best instincts on things and quickest instinct on things and understanding of things, and also could tell how other people were thinking, incredible empathy, and could help you divine how other people were thinking. And that was an exceptional trait that I think made for an exceptional board member.
What's the secret to a happy marriage, Joey?
My wife's uncle has this saying that if I say something and my wife's not around to hear it, am I still wrong? So I appreciated that. And I think it's important to, of course, love each other, respect each other, but also have opinions when they're really important to have opinions. But you don't need to, this is the opposite of my work advice, you don't need to lob in opinions when it's not necessary to have an opinion.
I love that. What would you most like to change about the world of venture? You see venture almost from the outside. What would you most like to change?
I don't know. I don't really think or care that much about it. Not to criticize it all. I don't spend time thinking about what I'd like to change in venture because I don't spend a lot of time thinking about that. So I don't know. I guess maybe one thing that came out of the last environment was I do think it was dangerous for a lot of companies to be overstuffed with cash. And I think that was a danger to more companies than it was a help to.
2028, we do another show. Where are you and where's IAC then?
I can't think that far ahead. That's a long. I'll still be at IAC, I think. How about that?
How far ahead do you think?
Look, in planning our business, we do think multiple years ahead. In planning my life, I can't think that far ahead. But for sure, in planning our business, we think about businesses in a forever timeline, and so that's the balance of short term and long term. But we want to think about what the market is multi-years out, for sure.
Joey, thank you so much for putting up with my questions on parenting, cash, financial markets. I so appreciate it, and you've been a fantastic guest, my friend.
Thank you, Harry. This was great.